5 Fundamental Wealth Strategies. Consider the following scenario. You want to travel from point A to point B. Point A represents your current financial situation, while point B represents financial freedom. Would you like to walk there? Would you ride your bike? Or would you prefer to drive? The answer is obvious. We'd prefer to arrive as soon as possible. However, most people prefer to take the long route to financial success. In this video, we will learn how to achieve our financial goals much more quickly. This will be a breakdown of MJ DeMarco's book, The Millionaire's Fast Lane, in which he explains how he went from being a 26-year-old living in his mother's basement to becoming a millionaire at the age of 31. To begin, we must understand the distinction between what he refers to as the sidewalk, slow lane, and fast lane of making money. To accomplish this, let's create a character for each category. Those who travel in the sidewalk paths to wealth are one step away from being broke. They tend to spend as much money as they make, regardless of how much money they actually make, and there is no actual financial plan. They are one unexpected circumstance away from financial disaster, which makes it easier to blame circumstances for their financial difficulties. It is income plus debt equals wealth, according to the sidewalk's formula. For most people on the sidewalk, wealth means having nice things: the car, the clothes, the gadgets, taking vacations, and enjoying the best things in life has to offer, even if it means going to debt to buy those things and paying them off as they go. People on the sidewalk, for the most part, have little to no savings and no plans for retirement. The majority of their nice things are paid for, and they rely entirely on the income provided by their jobs. Those on the sidewalk are unlikely to accumulate true wealth because their perception of wealth is linked to material possession and consumer behavior. The sidewalk has little to do with money and much more to do with mindset. There are many people on the sidewalk who have high income but are struggling financially due to their spending habits and lack of planning. According to MJ DeMarco, beliefs become actions and actions lead to results. If our money beliefs were reflective of the sidewalk mentality, we would most likely not be able to accumulate wealth. Some may remain trapped on the sidewalk for the rest of their lives, while others realize that this perception of wealth isn't working and begin looking for a better way to achieve wealth, which may lead many to the slow lane. The person in the slow lane has a slightly better financial plan than the person on the sidewalk. The typical slow lane is generally represented by the professional worker. This person focuses on developing a career and will typically obtain an education in order to obtain a better paying job, which is still a part of the slow lane life. However, there is usually a plan in place to pay it off. In the event of an unexpected emergency, a person in the slow lane may have a good savings account or an emergency fund. A person in the slow lane uses traditional wisdom to accumulate wealth. They work, live on a shoestring budget, and invest in financial assets. Salary plus market investments equals wealth, according to the slow lane formula. A person in the slow lane is more educated about money management and focuses on building wealth through the use of financial assets. They understand the power of compounded growth, and they will most likely become millionaires, though it will take decades to get there. Compounded growth is a powerful tool that can generate massive returns, but it is dependent on one of the assets we cannot replace: time. In contrast to the slow lane or the sidewalk, more income is controlled by a boss and assets are controlled by unpredictable market forces. A person in the fast lane or the sidewalk focuses on maximizing earnings with the intent of skipping the first 20 to 30 years of wealth creation and jumping in where the real fun begins. Instead of settling for a financially secure life, those in the fast lane prioritize having complete control and leverage over their income and assets. People who live in the fast lane decide on the lifestyle they want and work hard to achieve it, no matter how unrealistic it may appear to others. Those in the fast lane, like those in the slow lane, live below their means, but with the intention of expanding their means in order to continue growing their lifestyle. For someone in the fast lane, the wealth formula is net profit plus asset valuation equals wealth. The ultimate goal of someone in the fast lane is to create passive cash flow for life, thereby creating a lifestyle with an abundance of two of life's most valuable assets: money and time. A person in the fast lane focuses on building wealth much faster than the average person, with the goal of enjoying both the extra time and money while they're still young, and continuing to develop their wealth into their later years. There are numerous examples of ordinary people taking the fast lane and becoming wealthy. A guy who started selling rocks as pets and sold 5 million of them in 6 months, becoming a multimillionaire, or a guy who invented a camera for the front door of a house and sold the company for $1 billion 5 years later, or a person who started sharing videos online and made millions of advertising deals a few short years later. As we can see from these examples, taking the fast lane is entirely possible and can aid in the creation of wealth at a much faster rate than traditional methods. How the slow lane and the fast lane become wealthy. Those in the slow lane begin investing a portion of their income in market investments such as retirement accounts, stocks, or mutual funds. This is where they use compounding growth to build their wealth, though it may take a few decades to get there. Assume a person in the slow lane starts investing 10% of their $60,000 annual income. This translates to a yearly investment of $6,000 or a monthly investment of $500. Let's also assume an 8% annual return compounded over time, which is the market average. They will have it for less than $87,500 in 10 years. In 20 years, they will have more than $274,000 in their possession. In 30 years, they will have nearly $680,000, and in 45 years, they will have slightly more than $2 and $3 million. This sounds great, but consider that 70% of the wealth was created in the last 15 years. The first 30 years only accounted for 30% of the total. The age at which we begin investing determines how much we will have by the time we retire. If they begin investing later in life, they will either have to retire later or focus on living more frugally during their working years in order to contribute more money to their retirement fund each month. Now, in the book, M.J. DeMarco emphasizes that compounding growth is powerful, but it is only part of the plan, not the entire plan as most people in the slow lane believe. A person in the fast lane is concerned with having complete control over their money. Let us return to their wealth equation. Net profits plus asset valuation equals wealth. This entire equation is geared towards increasing wealth. Net profit is simply the number of units sold multiplied by the profit per unit. For example, if you are able to sell 1,000 units at a profit of $1,000 per unit, you will earn $1 million. There are numerous ways for math to work here. 10 units at a profit of $100 or 100 units at a profit of $10,000. Both of them give you $1 million. The point here is that income in this lane can be managed. We can hire more people to sell more products, and we can use automation systems to streamline our own processes. We can also use advertisements to increase traffic to our store and increase sales. The various components that generate revenue in a business can be calibrated and improved to generate more revenue. Now comes asset valuation, which typically refers to the value of your entire business. Most people who live in the fast lane do not exchange time for money. They exchange time in order to create a business system that generates money, which is an asset in and of itself. Many other businesses are willing to pay top dollar for an effective and efficient business system to incorporate into their operations. It is not uncommon for a business to be sold for 5 times or more its annual revenue. Now, here are a couple of methods for profiting from asset valuation. The first one is to sell your company to another company or investor. This way, you can exit the business with a good amount of money and be ready to retire. The second one is to take the company public and sell your company's stock on the stock exchange. This allows you to sell a portion of your company to the public while still maintaining some ownership in the company. Some companies in the stock market sell for 10 times or more their annual revenue. Compounded growth is a valuable asset for those in the fast lane. Because wealth is built at a much faster rate in the fast lane, it is possible to skip the first 20 or 30 years of compounding that the average person would have to go through. Consider that a person in the fast lane takes 5 years to build and sell a business for $2 million, which is not uncommon. This will essentially allow this person to skip the first 45 years of compounding that our slow lane friend had to go through in order to reach the same point. But how do you create a fast lane business? MJ DeMarco's book contains a few rules that may assist you in establishing your own fast lane business. Number one, control. We need to be in charge of our business. For example, someone starting an affiliate marketing business violates this rule because they do not have control over the product or even the profit made per product sold. The person who owns the product has control over the product and the commissions that they are willing to pay. Number two, entry. Everyone will try to get in if it is simple to do so. We've all seen business trends promising how easy it is to make money in a specific business. And those who start quickly realize that because it is so simple to get started, everyone is doing it, creating massive competition for the entrepreneur. Number three, need. A good question to ask ourselves when we start a business is, what problem am I solving? Are there people who are actually looking for a solution to this problem? Not everything we are passionate about can be a successful business. Demand for a solution to our problem is required for a good business. There can be no business if there is no demand. Number four, time. In order to build a fast lane business, this business must also allow us to walk away from it while continuing to generate income. If not, we have created a job rather than a valuable asset by developing a business system that can function without you. You have the option to either walk away while it generates recurring cash flow or selling this system to someone willing to pay a fair price for it. And number five, scale. In business, scale means the ability to increase revenue faster than expenses. In other words, we are creating a system that will allow us to sell a large quantity of products at any given time. Let us know what your thoughts are through the comments section below. Also, don't forget to share it with your family and friends. Thanks for watching!